Number one, Meta Platforms, ticker symbol META. Everyone knows this. It's Meta, right? Mark Zuckerberg. Well, total revenue on this company continues to accelerate. As of the last quarter, we're now up to over 26% revenue growth, being at one of the top companies in the entire Mag 7 for overall growth. But this is where the value comes in, right? Not only are we ended up seeing a very diversified stream of revenue, very recurring, advertising based, in a world of physical AI or artificial intelligence in general, we're still going to need advertising, okay? And Meta is actually going to help use that advertising to help put out more advertisements that have higher conversion rates, which hopefully means more people come to the platform. As we can see, now at over 3.5 billion total people, still growing at 7.6% growth year over year, having accelerated over the last year. And the average revenue per daily active person continues to climb up. Just since September of 2022 to September of 2025, the average revenue per customer has gone from $9 to over $14. Even the average operating income per customer has also climbed. Not as fast as the rate in which we're growing on a per person basis on revenue, but still growing very well. Whenever we take a look at total advertisements that have been delivered to those customers, although we have scaled the total amount of overall customers, the amount of delivered ads is even higher than that. And on the amount of cost per advertisement, well, this has really shot up. So if we go ahead and see this in a consolidated view, what we end up seeing is that the worldwide amount of delivered advertisements is now up over 14% year over year, while the amount of money that they're making per ad on that 14% increase is also up 10% as well. The advertising platform on Meta is unbelievable. Now, one of the reasons that I'm so interested in Meta here is how much it's recently sold off. And the reasoning for that sell-off is not due to anything that I think is that material. Well, obviously, they had to pay over $15 billion in taxes, but that's their taxes. That's something that they can't avoid. So what you ended up seeing is this one-time tax charge ended up bringing down their EPS down to $1 when it was expected to be above $7 per share. Whenever you adjust it for that one-time tax charge, what we still get is EPS above $7 and beating expectations at $7.25. Another big reason for the sell-off was their increase in capital expenditures, now above $18.8 billion as of the most recent quarter, and the growth rate on that continues to climb, now at 128% increase in spend on capital expenditures, the purchase of property and equipment, in this case, a lot of AMD and Nvidia chips, but that continues to increase not only as a percentage, but as a dollar amount. Now, to understand why I actually think that this is very beneficial, we'll go back to the amount of ads delivered and the conversion and pay on those ads, right? Artificial intelligence is helping them convert on those advertisements, which is actually driving more revenue. We wouldn't have seen an increase in their total amount of users or the amount of money that they're making on those users if it wasn't for some of these effects that they're making in artificial intelligence. The only way they do that is if they end up building their own systems, which is going to cost them the cost in capital expenditures, focusing on artificial intelligence in the quarters and years ahead. Another thing that helps is my focus on Nvidia. It currently is my largest stock in my portfolio. It's not actually something that I'm buying this year just because it already makes up over 43% of my portfolio, but all of the spend from the neoclouds and hyperscalers and companies like Meta, for example, all go back to feed into my main position. So love this from Meta, and I'm actually a big supporter because it benefits the rest of my portfolio. Now, we can look at a variety of different metrics, but Meta honestly ends up showing up in a very similar way whenever compared to the rest of the Mag 7. In fact, this is actually just Mag 6, taking away Tesla because they're not very profitable right now, so they would be way, way up on this chart. But Meta is by far the cheapest out of any of these companies, especially whenever we're looking at more of the application layer software names that we have here, including Nvidia as well, which also ranks among some of the lowest in this list. Currently, Wall Street has this company at $828 per share, or about a 25% upside from where we are at the time of recording this video, which is roughly about $650 a share. Next up, unsurprisingly, we have SoFi Technologies, ticker symbol SOFI. Now, I'm not going to go through this entire business model just because I cover everything about this business constantly on this channel, but at the heart of it, it is a digitally financial bank that has been growing members faster than most. What we end up seeing is that the most recent quarter is still growing members at roughly 35%. And according to the CEO, Anthony Noto, they believe that they can potentially hold up this level of growth for the next 5 years, bringing them to over 50 million members. That's the long-term goal. And their products, which are the checking accounts, credit cards, personal loans, home loans, student loans, that end up getting brought onto that is growing even faster as more members are choosing to use more of their services over time, compounding that amount of revenue. And that's exactly what we're seeing. So financial services, which is anything that isn't lending out money, including credit cards as well, is growing still at roughly 80%. And in fact, if we take a look here, compounded annual growth rate over this time period is 97%. While lending revenue is still growing at 16%. And then lastly, in the purple here, growing the slowest at only 11% is their technology services revenue, which for the most part is not even there to bring on a lot of revenue. It's just to increase their speed of overall product cadence. So helping engineers end up developing more products to stay ahead of the other competition. This is one of my more favorite charts on SoFi. Not only do we have revenue in the top blue, but as we go down and increase the total amount of costs and take a look at different aspects of the business, what we can see is that they're all improving. Down to contribution profit, adjusted EBITDA, net income. As we flow further down that income statement line, it still looks very good. You can also see this directly in margins, that contribution margin, adjusted EBITDA margin, and net income margin have only improved over time. Now, we have some massive catalysts here. Obviously, many people know about the S&P 500 inclusion that is very likely to happen this year, which usually brings up stocks like SoFi and their size, roughly 15 to 25% on average. But what we end up seeing is that they are a lending company, right? They are a fully licensed bank. But that amount of lending that they've been able to do recently has absolutely exploded. Now, they also have another aspect of their company, which is the loan platform business. This recently started.
Our next company is IonQ. Now, most quantum companies are still trying to prove the technology, or they're trying to force a business model on top of it. IonQ is pushing both forward at the same time, and that's finally starting to show up in their real results. Quarterly revenue jumped from the low teens millions to nearly 40 million in Q3 of 2025. Almost all of 2024 revenue in a single quarter. That one single step change shifted IonQ from a research story to an operating business. And I think that margins really explain their approach, because gross margins have sat below 10% by design. IonQ has been willing to sell systems at near cost to get embedded early with governments and enterprises. And I think that they're banking that the payoff comes later, as access, usage, and services begin to matter more than the hardware itself. Where IonQ stands out from the rest is its fidelity. 2-qubit gate fidelity at 99.99% means error correction becomes practical. Fewer physical qubits are needed to do useful work. IonQ wins on reliability, which shortens the path to real workloads. The stock already reacted to that progress once, running from about $8 to the mid-$80 in 2025, and then pulling back roughly 40% and settling at around $50. That looks like consolidation after a major repricing. To me, it's not a broken story at all. Now, what ties this together for them is the shift from selling a system to becoming the system. IonQ is using early contracts to get embedded, and its technical lead gives customers a reason to stay embedded as workloads begin to grow. For IonQ, the single metric that matters the most to me is their revenue trajectory. Continued step-ups confirm IonQ is turning quantum into a real platform business. Analysts give IonQ 49% upside over the next 12 months. That now brings us to our favorite AI company of Nvidia, which isn't just a chip supplier anymore, because it's the platform that's underneath all of modern compute. Data center revenue hit $51 billion in Q3 of fiscal 26, and that is up 66% year over year, and it's now making up 90% of their total revenue, where that scale funds everything else that Nvidia is building, leading to the Vera platform, which delivers 5 times inference performance, 3.5 times training, and it runs tokens at 1/10 1/10 the cost. Lower token cost means everything in the world of AI and expands how much AI can be deployed at scale. These gains come at the system level. It's compute, networking, memory, and software designed all together to work together. That's why customers buy entire racks, not just chips. And their demand just keeps building because compute now scales 3 different ways. It's training, it's post-training, and it's inference. That combination is what sustains infrastructure demand even as individual models begin to mature. And of course, software adds another layer on top of all of that. Nvidia AI Enterprise is running at a $2 billion plus annual pace, growing triple digits, recurring revenue that compounds as the installed base also continues to grow. To me, their runway ahead, it still remains so large and so far out there. Most global computing infrastructure still hasn't even transitioned to accelerated compute, which leaves years of modernization ahead for companies like Nvidia. The single metric that matters most to me about Nvidia is their data center revenue growth. As long as that remains strong, then it confirms to the world that Nvidia's role is at the very center of this compute transition. And even today, analysts are showing Nvidia a lot of love with 44% upside over the next 12 months. Our next company is Lam Research, one of the core companies sitting behind every advanced chip build. Now, Lam doesn't just design chips. It supplies the etch and the deposition tools that make advanced logic and memory possible at scale. Looking at a wide range, their revenue grew from $1.6 billion in fiscal 2006 to $18.4 billion in fiscal 2025. That is an 11 times increase, which is also roughly double the broader semiconductor market's growth rate at the same time. That happens to be structural share gain. It's not just cycle exposure. And then gross margins stayed flat, but operating margins expanded from the mid-20s to 32%, and net margins hit 29%. That's the definition of operating leverage. Fixed costs like R&D don't rise as fast as revenue, so profits begin to scale faster than the sales. The cycle profile has improved too. Drawdowns moved from negative 56% during the GFC to roughly negative 15% in the most recent normalization. Lam captures the upside without giving it all back in the downturns. For me, the current driver for them is high bandwidth memory, or HBM. Each stack requires 2 to 3 times more etch steps per wafer, directly increasing Lam's content per chip. With HBM production growing at 50% or more annually through the next 2 years, this is a new demand vector, and it's not like the normal memory trajectory that you would see where it would boom and bust every other year. Lam generated $5.7 billion of free cash flow in fiscal 2025 at a 31% free cash flow margin, returning 80% to shareholders through buybacks and dividends. And as chips get more complex, manufacturing steps rise, and Lam's tools sit directly in that path. AI and HBM make manufacturing a heck of a lot harder, which only increases Lam's relevance over time. Now, in this scenario, the single metric that matters the most is operating margin. As long as margins expand faster than the revenue during recoveries, it confirms Lam's operating leverage is still intact. This is one that I will keep on the ready to buy whenever there's a future dip. Now, this next company is Amazon, which many of you know is my former employer. And for this one, the only way to really understand this stock is to zoom out, and I mean zoom way out. Amazon has never moved smoothly. It surges ahead of the market, and then it spends years going sideways while the business begins to catch up. From 2010 to 2014, it absolutely exploded, and then of course, it stalled. From 2015 to 2018, it broke out again. And then, of course, it went flat again. After the 2020 surge, the stock for the most part has been sideways. I mean, to summarize it, they tend to outperform in microbursts, and then they'll underperform or just pause for long periods. That's always been their pattern. And strangely, the breakout never really comes at peak excitement. It just comes after a lot of boredom. Since 2023, Amazon is up 15 to 20%, while the S&P 500 is up 45 to 50%. 2 years of underperformance right on pattern. Now, AWS growth is accelerating back towards 20%. And historically, Amazon doesn't leave holding patterns until AWS turns first. Operating income surged from $12 billion in 2022 to $69 billion in 2024. That's 5 times growth in just 2 years. Free cash flow swung from negative to $30 billion plus. This isn't just cost cutting, it's operating leverage showing up at scale. And yes, data center spending is rising again, but unlike past cycles, this build out is being funded by profits, not just balance sheet stress. Thankfully, Amazon is starting to invest from their strength. And today, the setup mirrors prior breakouts. The stock compressed near highs, momentum is constructive but not overheated, and volume is starting to expand. So it's the same backdrop that we see today. In my mind, Amazon has done the hard part. Margins rebuilt, cash flow restored, AWS is reignited.